start the business, you should always be planning for your exit. You run a big process, it becomes very public very quickly.
Yeah.
And vendors don't like that.
No.
They don't want that. They want the staff to know about it. They understand that they're responsible for 50 households' income. So just really understand what your personal goals are, what your personal drivers are.
Yeah.
Do you want to retire? If you're 70, then fine. But if you're 40, do you really want to? You will be giving up an income stream. You'll take some capital out of this thing, but if the business is returning a couple of mil EBITDA to you, you're taking out a decent check, that will stop. Understand that if you're that young, you're then going to probably say, well, I want to do something else. So, you're putting two parties together, and, and especially with an earnout process in there and, maybe a partial acquisition, it's really important.
Hi, I'm Josh, and welcome to Two Commas, the show all about exits, and particularly multi-million dollar exits. This season marks a move into a space which people have been asking us for, which is to start talking to those folk that surround the exit transaction, so advisors, lawyers, investment bankers, etc. And today on the show, I'm really excited to introduce Greg Young. Greg Young has been around the investment and advisory space for around about 30 years, not meaning to age Greg, but he's done both investment banking, M+A advisory, corporate strategy work, and he started life as an analyst programmer, but I'll let him tell that story if he wants to go back that far in his career. And so today Greg's going to be talking to us all about structuring of deals, raising money, getting debt in place, and all those sort of interesting things that people don't really get the opportunity to listen to so much. So Greg, thank you so much for coming on the show. Really pleased to have you here.
Thanks for having me.
So I always start these conversations with a bit of a backstory, so an introduction opportunity for you to the audience. So tell us the backstory of Greg, please.
Interesting, you dug out analyst programmer. That was a long time ago, but that was kind of the start of my technology sort of career. I was ended up with EDS in Hong Kong, and then with IBM in Hong Kong. So it's where I really started my M&A work, was with IBM. We used to call it outsourcing, but essentially it was acquisitions. So it wasn't really mergers, it was kind of mergers, but we just would do a lot of acquisitions, go out and buy companies, buy assets, buy capabilities from around Asia. So that was really where I cut my M&A teeth doing that. Came back to New Zealand a bunch of years ago with an American wife, settled back here. 15 years ago, I think it was, we decided to set up 360 Capital, five of us at that stage. Put it together, we researched the market, we used Minters to help us with all our regulatory sort of stuff. We decided not to go and compete with the big guys. We just wanted to be playing in that mid-market, which is really the fat part of the market where the majority of the businesses are. So that's kind of a brief thing. Don't want all the boring details.
Okay, we'll dig some of those up as we go, no doubt. Okay. We'll try and avoid the skeletons.
Yes, please.
So 360 Capital, so M+A Advisors.
Yep.
For the unexperienced, what does that mean? What do you do?
Essentially, we work with on buy side and sell side. So on the sell side, you're working with business owners who are looking to exit either in full or in part their business. They're generally in the mid-market founders that you're working with. They're people that could have built this business up over 30, 40 years. It could even been something that's been in the family for a long time. Often it's not. It's a little bit sort of shorter timeline. So we do that. We help them sell their business. It's something that business owners will do once in their life, generally once in their life, especially when you get to the older owner who's been in this for 30 years. They don't know how to do this. They often get screwed over by somebody who turns up, makes them an offer, especially a trade buy, and underpays for the business. So we get involved with them quite early on in the process. We often refer to them by accountants who have a long-standing relationship with their clients as trusted advisors. They'll come to us and say, look, I've got this client who wants to do this. And so we'll work them through the process. We'll meet with them a bunch of times and, just handhold them through how the process would look. And then hopefully we can bring it to the market. On the acquisition side, we're often retained by trade buyers and private equity to acquire assets on their behalf. So we'll go out, we deeply research the market. We're very research-led, data-led. So we've pretty much mapped all the mid-market companies in New Zealand. We can tell you what their size is, the enterprise value, we estimate all their financials, their EBITDA, and so on and so on. So we've got a database that we've built of that. So it's very powerful on the acquisition side when client comes to us and says, I want to buy a FMCG manufacturer doing this in this sort of space. And they'll give us the requirements, we'll research it, and we'll put offers together. So a lot of what we do is very bespoke and under the radar. We don't run huge, big public processes. Most owners don't want that. There's a need for confidentiality. They try to keep that process away from their staff as well, and suppliers, customers. So their confidentiality sits on both sides of it, whether it's an acquisition or a divestment. The M&A is a terminology that's used. A merger is really not so much a thing, especially not in the mid-market. It's a label that's applied to the sector we're in. However, smaller businesses do not usually merge. There's always somebody on top. Somebody's doing the acquisition. What else can I tell you? So the divestment side, we get in very early, as early as we can. We always recommend to business owners to get in touch with us as early as possible. Even years before the process. Absolutely years. We have clients that we've been working with for 10, 15 years that are still planning on exiting. But they one of the things that a lot of people talk about use is the term preparing your business for sale. You should do that from day one. When you start the business, you should always be planning for your exit. If you're not looking at that, your business won't run properly. Always think about it as, what is my business worth? And if you're looking at what is my business worth, you're getting your staff right, your process right, your systems right, your regulatory right, all those sorts of things. To knowing that a buyer coming in will want to look at those things. So you could almost take a due diligence checklist, and use that as a bit of a map for how you run your business. These are the things a buyer is going to want to say. If you've got skeletons in your closet, a buyer will find those during due diligence, and that will hurt the value of your business. So run a clean business, run it from the beginning as if you want to sell it, and you should have a good result. Of course, you've got to be in a market making profit as well. Yeah, profit's a key driver.
Yeah, got it. That's a really helpful intro. So critical term that you pointed out there. Imagine the DD that your business will need to go through when it comes to sale time, and run your business with that in mind. That's an absolute pearl of wisdom there. Let's go back to the start of the description there. So 360 Capital, mid-market, M+A Advisors.
Yep.
What does mid-market mean to you?
So the market's basically, we call it three-tiered. At the lower end, smaller end of the market, you've got business brokers. They're selling your cafes and your hospitality things, and smaller sort of businesses, usually with an enterprise value of, say, up to $1 million, but the majority of them are going to be in that sort of $200,000-300,000. So we call those buy a job. So you'll buy a business at that level to get an income which is equivalent to what a wage or a salary would be. Generally fairly cheap to buy those. You usually buy them on, they talk about these crazy acronyms about how they measure the profitability of these businesses, earnings to a working owner and all this. So the next level is the mid-market. That's where we play. At the top end is the Goldman Sachs type space. And it depends on who you're talking to as to what mid-market is. You talk to Ross George over Direct Capital. He'll say to you, the top end, he'll say starts at $500 million. Right. But really we look at the top end as being sort of 150, 200 mil up. So the mid-market, we would say, is anything between 1 mil and 150 mil. Right. We have tended to specialise ourselves in that 10 to 50 mil enterprise value. We do some smaller and we do some larger. But the vast majority of our business would be in that sort of 10 to 50 space, and probably around a 20 mil enterprise value.
Yeah, got it. And so in that range, you're probably dealing with the founder, owner.
Yes.
There may be a board structure in place.
Often not.
Interesting. We'll come back to that. There's probably at least one, obviously, but there could be multiple shareholders involved in that transaction as well. Yep. But it would represent, I've heard this, looked into this data, I'm curious on your thought. So in New Zealand, 10% of businesses make it to more than 1 million of revenue, and 1% make it to more than 10 million of revenue, give or take, 1 or 2% depending on the year and kind of year of founding and that sort of stuff. Whilst that sounds like, from an M&A standpoint, not necessarily kind of massive numbers, when you talk about $500 million or $1 billion, as there has been transactions of reasonably recent times in New Zealand at that sort of level, you're actually dealing with a small proportion of businesses in the total number of businesses in New Zealand.
Yeah, but I think I don't know what the exact number is, but it's something like 90% of New Zealand businesses have one employee. So, they're not businesses as we really, they're often, limited liability company for a tradie or something like that. So they're legitimate, these guys are making money and paying their GST and their tax, and they run it as a business so they can run their expenses through and so on. So you've got to take that out of it. And I don't know the stats that you've got, but we talk about the pyramid. So at the very top, you've got a very small number of businesses. In the mid-market, you've got a big fat area with lots of SMEs and so on. At the bottom of the pyramid, you've got all these one-man bands. Yeah. So we've seen different stats come out of different entities about sort of estimating what it is. But those are the businesses with 10 mil or north of revenue that are attractive to investors, to trade buyers, because generally you've got to get above 10 mil to be able to have any reasonable EBITDA coming out of your business. That's kind of our inflection point, is a 10 mil revenue business. If you talk in the FMCG space, unless you're up to 10 mil, you're not going to start firing. Yeah. You won't have the shelf throughput in our duopoly. You won't get into the supermarkets. So you've got to be trading up to that, above that sort of level. Yeah. And then the profitability comes with it. We're being a small firm, we don't do thousands of deals a year. So we've been around a long time now. We've got good relationships with accounting firms and so on. And accountants are the best people to be dealing with, because they understand their clients. They'll have long-standing relationships with their clients, and so we typically work in very close, proximity to the accountants on these deals. Yeah. But we don't do hundreds. We'll do a dozen deals a year, sort of deal.
Got it.
Small firm.
So the world of M+A is like tech in that it's full of acronyms and jargon. So I'm going to kind of unpack some of these as we go. So what is enterprise value?
Enterprise value, it's what you can sell your business for. Now, there's lots of ways of valuing a business. Yeah. Some people still drag out the whole discounted cash flow model. Don't. But typically a business is going to be valued on a multiple of earnings. And that earnings could take various forms. Typically, we'll work on what's called an EBITDA, which is earnings before interest, tax, depreciation, and amortization. So it's because every owner will have different tax requirements, liabilities, depreciation methodologies, and all that sort of stuff. So you're typically trying to take it out so you can create a measure that can be compared with other companies, rather than, because when a business publishes its profit results, the true profit results, they'll have taken all those things out of it, but that doesn't tell you what the true position of the business is, and enable you to be able to compare it to others. So that EBITDA number, or EBIT sometimes is used, we apply multiples to it. Now those multiples vary from sector to sector and time. We've just come through a couple of fairly tough years, so our multiples are under a lot of pressure, and negative pressure. So businesses are not transacting for the same sorts of values. Certain sectors have been hit harder. SaaS businesses have been crucified with multiples. So we use those earnings number and multiplied by a multiple that gives us an enterprise value. Of course, it's theoretical until you find a buyer. Yeah. So we always try to tell our clients that a business is worth what somebody is prepared to pay for it. Our job is to get them the best price, to present the business the best way. We use that sort of form of information memorandums and information sharing and all that with potential buyers. And so we do run a process. So that enterprise value is theoretical. For every business we bring to market, we have to run an appraisal on it. We do an appraisal. So we try and set the expectation with our client as to what their business is worth. But we don't share that with the market. We go to the market and we try to get the best price that we can for our client. Yeah. But at the end of the day, people don't generally overpay for businesses. People are well advised. So on the other side of a buyer, we'll have advisors and so on, helping them understand the value and what they're buying and how much they should pay. Yeah,
of course. So a couple of questions jump out, but I'll just have a quote for you first here. Tony Falkenstein was on the show a few weeks ago. You obviously know Tony, good friend of mine, and my original employer, actually. He said if you want to buy an overpriced asset, deal with an M+A advisor. So in other words, they get a great exit price for the owner of the company. If you want to buy a cheap asset, deal with a business broker. Words from Tony, by the way. So just something to cogitate on. But the two key numbers that you were talking about there was the EBIT and then the multiple of that EBIT.
Yep.
So let's just dig into that EBIT for a second there. So EBIT is something which is historically factual, hopefully, and there's not been any cooking of the books or anything weird that's gone on.
Due diligence takes care of that.
Great. And you'll see a trend that's been going on over time, which no doubt influences the multiple, because if it's trending upwards, then someone may pay more. But are they buying the business of the past, or let's say we're just coming up to the end of the financial year and when we're recording this episode, and so are they buying the business's EBIT from this year, from last year, or from next year? How do people play that out?
You typically look at the last 3 years of financials. You'll also possibly weight them, the years. We've got a transaction on the go at the moment where the buyer has come back with a valuation, a registered valuation on a business that they're looking to acquire, and they've applied a formula, and using a weighting on the last 3 years, but they left out the current year, which has a big uplift. So we've agreed the formula. We said yes, the formula sounds good, and when you apply it to the current year, we've got 9 months of actuals, and we've got 4 months to come. We apply it to that. It actually is a good deal for the vendor.
Right.
So you do have to have current results. We typically get to this far towards the end of the year, and we will always incorporate the last 3 or 4 months. Yep. We'll usually use a forecast. Also, businesses aren't necessarily buying the past. They're all looking for growth and a future growth. And, we try to stay away from any hockey stick businesses because they're just unbelievable. But we will use forecasts, and the forecasts are always difficult you can't guarantee them unless you use a form of earnout. Yeah. So a forecast is something to say to a buyer, yes, we think this business can continue to grow. So a buyer will look at that and say, yep, it gives me comfort on the multiple I'm paying, but I don't want to overpay for future business. Mm-hmm. So often an earnout is used, and our earnout is where they will pay more for the business in a period, 1, 2, 3, 4 years. If the business hits their projected targets, they'll pay extra for the business. Yeah. Based on the performance being hit. So if from a vendor's point of view, if they're sitting there saying, I think I can double revenue or double profit in 3 years' time, and the buyer says, well, okay, I'll pay you extra if you do that, you better be sure that you can do that. Hand on heart isn't going to work. You've got to actually know that you can do that in the business. Yeah.
So in the case of the earnout, and I have a section of questions on this, but let's just kind of delve into that now, if that's okay. In the case of earnouts, is it that there's a proportion, like a chunk of the agreed price that's left on the table? So there's some cash now, some in a year, some in a year, some a year after that, and then there's a multiple that can get applied to that if there's over-earning? Talk me through a typical earnout.
There is no typical earnout.
Right.
Yeah, you can do anything you want. It's basically, even an earnout could just be a deferred settlement. You could sort of say, I'm going to hold back $2 million of the purchase price, and you have to hit that number. But often the problem is when a buyer comes in, they then start to touch the business. And so a vendor's sort of sitting there going, well, I don't want you fiddling in the business because I'm the one that's going to lose if you fiddle on it and you can't, and I can't deliver that sort of profit to you. So there's a lot of mechanisms that are put in place to control that and how that's sort of all done and quantified and so on. But there is no typical earnout. We typically have seen them to be smaller percentages, like in the past 10 or 20% of the enterprise value might be encumbered with an earnout, but we've seen recently some up as high as 80%. We've never done a deal like that, but we've heard of others doing it. Now there'd have to be a special reason for doing that, and I don't understand why they would have. But this is what we've heard from from the law firms.
Yeah, wow. I'm going to quote you here. Hopefully it is you. Researchers dug this up. The numbers in an earnout mean nothing if the governance isn't structured properly. That's
just what I mean. Those are controls you put in the sale and purchase agreement as to how, because the governance, if you're the exiting owner and you've got part of your enterprise value tied up in an earnout to be paid at a later date, and it's based on performance, Well, if you've got somebody coming in to do it and they're going to muck around with governance, like spend a whole lot of money and, hire a whole bunch of staff and do all this sort of stuff, well, you're not going to hit your earnout. Yeah. So the governance is very, very important.
And so do you also see regularly where the founder, the owner, stays inside the business over that earnout period? So that's kind of a typical way that's associated.
Often you'll see, we did a deal recently where it was an 80% transaction. We sold 80% of the business. The vendor stayed in with a 20%, and there's an earnout kicker on it for him in 2 or 3 years. And so he has to stay in. He will stay in, but the idea is he's getting old. He wants to reduce his time in the business. So over those 2 or 3 years, he'll go from running the business 100% to possibly a day a week or day a fortnight or whatever.
Yes.
So, but with the governance mechanisms is really important, and that's what a sale and purchase agreement will define. So, and the business needs to be managed with those governance rules in place. One other thing is on that, when you start talking about sale and purchase and governance, is having a proper M&A lawyer do the sale and purchase agreements. We see a lot of deals tip over when a business owner, he's a founder, had the business 30 years, and he's never really needed too much technical legal assistance. Wills and leases, we call it. So they're probably a family lawyer, they're a suburban lawyer, really good for the business, and they're cost effective for the business. But when you come to sell that business, they haven't run a process like that. They may have helped buy some houses or do some conveyancing or whatever, and the odd sort of small bits and pieces. But they, when you're getting to a $20 million business, enterprise value business, it's there's a lot of complexity there, and so it's really important to get a proper M&A lawyer, a really good M&A lawyer, and they're the ones that will protect the vendor with the governance stuff and an earnout. They'll get the earnout structured. Getting that earnout structure is key.
I couldn't agree more. We met each other through the startup investing world, and that space has its own form of complexity, not as to the detail and level that the M&A space does. But I came across something recently where they had no cliff and vesting on the ESOP that was being given to staff. And so they had people that were coming into the business, staying for 3 months and then walking away with percentage points of shares inside the business. It was appalling. I read this agreement and I said, who wrote this for you, family lawyer? Had no idea what they're doing, and they didn't have the scruples to refer it to someone that did. But I have a section on legal because it's really important, and it's something that you've talked about quite a lot. So we'll come back to that if that's okay.
Yeah.
Earnout disputes. So what are the most common ones, and how do people go about avoiding those?
Very often, earnouts don't run full term. There'll be
Why?
Everybody's happy. Sometimes there'll be disputes, and sometimes there'll be, guys said, the example I just used, the 80%, 20%, the 80% holder says, look, I'll buy you out now. Right. You don't have to wait to 3 or 4 years or whatever. I'll just take you out now. Okay. And, this often things are going really well. I'm happy with the business and everything's going along well. There could be a situation change with the owner, with the vendor, getting older, illness, that sort of stuff. Things happen. Yeah. They often will be paid out. Okay. In a variety of ways.
And if that doesn't happen, if there's some form of a dispute, have you seen those before?
We have courts.
Yeah, right.
We have lawyers in courts. Yes. So they can be quite heavily disputed, and they can be messy. We haven't, fortunately, ever had one go like that. Yes. But they do happen.
In an ideal world, you said that earnouts are, widely variable in terms of how they're structured, but do you have a view on what the best structure and approach to building an earnout which is fair and reasonable and kind of gives everyone a decent sort of outcome?
I think simple is good. I think that they get overly complicated. We have had some buyers who have wanted to do some very strange, complicated methodologies to determine them, and we like simple. I'm not smart enough to do anything too complicated. So we think that they should be fairly simple, based off agreed mechanism, whether it's an EBIT, EBITDA. It could even be a revenue-based earnout. But it's just so everybody going into it understands what their requirement is, what their role is in that earnout. And this is, as you said before, the governance, that's a really important part of it. But it needs to be quite clear and simple. people have a tendency to forget down the road about what they've signed up to. And a sale and purchase agreement getting dragged out 3 years later is not usually a good thing. So the easier it is for you to remember in your head what that deal is, probably the better. And don't overcomplicate it. Of course, you get into some of the, this is with the high end to the big end of town, those earnouts sort of structures get very, very complicated.
Yeah, right.
But a good lawyer will simplify that. We recommend some really good lawyers and who will take very commercial, give very commercial advice and help structure the sale and purchase agreement so that they're clean rather than overly fussy.
Yes. I've always thought that if you have to reach into the bottom drawer to pick up a contract, then something's gone drastically wrong along the way to get to that point. And so what I'm hearing you say, and this is interesting, is that commission structures, incentive structures for folk inside the organisation that are revenue responsible or revenue producing, the absolute best way to structure those is that they are very, very simple and straightforward, and preferably the person can do them inside their head.
Yes.
If this, then that.
Yeah.
And so I'm hearing you say that earnout structures should kind of be pretty similar.
Same thing.
Yeah, okay.
Yeah. Majority of business owners, and you get in that sort of mid-market space in New Zealand, they're not highly financially literate.
Yeah.
You get somebody who might, pick a business, earth-moving business, I'm just top of my head, and, really know their business, but they're not that financially literate. And, some of them might be, but if you make it overly complicated, even presenting a sale and purchase agreement with an overly complicated set of conditions like that and explaining an earnout, they just won't get it.
Right.
And if they can't understand that during the process, they're not going to understand that 2 years later.
Yeah, of course.
And you're exactly right. You should never have to drag a sale and purchase agreement or shareholders agreement out again. You should never be touching that.
Yeah, the premise of where you operate in the world essentially is that, because you mentioned great lawyers, and there's probably some others that you'll talk about as well as we go through, but the premise is that you're a specialist in what you do, and if you're a great earth mover and you understand machinery and the right kind of dirt and how to get people that know how to operate in that sort of space effectively, then why would you want to delve into the world of M&A and become an expert in it? It makes no sense, right?
Exactly.
So work with a specialist and an expert is what I'm hearing you. There'll be a question that I do need to ask, so share with me the degree of comfort that you've got in doing so. Fees. So how much do people pay you to do this for them?
Fees vary. The accounting firms typically will do quite large upfront fees. We will do usually a retainer. Depends on who the client is, the size, the complexity, and all that sort of stuff. We'll do a retainer, which is 10 to 20K, sort of thing like that. Okay. In that sort of range. For that, we'll generate the information memorandum, working with them to get all the information and so on. So we prepare that. We have it all graphically designed and laid out and stuff. And we're quite proud of our work on the information memorandum, so we think we do a good job. So with that, and then we go to market on that, and so then we're paid a success fee. So we're at risk during the process. So it can be quite stressful because if it doesn't go, we don't get paid either. The retainer really is nothing. It's insignificant in the whole scheme of things. Depending on whether on the buy or sell side, on the buy side, if we're working for private equity, the fees are a lot lower. It's private equity, but also we're working on bigger deals. Private equity at the moment in New Zealand has ballooned. We do a lot of Australian work as well. They've all got bigger check sizes now because their funds have got bigger. They've been successful. So more investors are coming there. So they're now pricing themselves out of our market, out of our space. So they would typically be 1 to 1.5% success fee. On a mid-market, on a sell side, you get at the bottom end, you get a business broker. They'll typically start at 8%, and you can always negotiate them down. They will very rarely will they get 8%, but that's where they'll start. So anybody listening want to sell a business or a business broker, negotiate.
Okay. I've heard 4 to 5 is the number that you should expect to pay to a business broker. Got it.
And so we're probably in a similar sort of area. It depends on the business, and often when you get if we're working on, say, a $50 million transaction, we look at it with a 4%, we just say, no, hand on heart, we think it's too much. So we will adjust our fee for that. We don't feel comfortable charging someone on a 50 mil deal, over $1 million on fees. We just don't feel comfortable in that. So we're typically because the business broker has got being in that sort of market size, there is quite a bit of work, and there should be. I don't know how they do it, but so with a larger business, it's probably still the same amount of type of work, so we can work on a lower fee. But before that, we do right from the very beginning. So we could be talking with them for years, right through the IM, the process, the due diligence, the sale and purchase agreement, the settlement, and all this. So we hold their hand right through the whole process.
Yeah, right.
So we think it's quite reasonable.
Yeah, it does sound it to me. So very much so.
And we can often justify our fee by saying we'll get you that over what you thought the business was worth.
Yes.
By hiring us, we'll run the process. The process will be easier for you, and we should get thanks to Tony, a better return for you.
Yes, great. So interestingly, brokers need to carry a real estate ticket.
We do too.
You do as well. Okay,
Yep.
I was just about to ask, are there any regulations or kind of controls that exist in your space?
When we first were setting up, we paid a lot of money to Minter Ellison to give us advice on regulatory structuring and setting it up. They set up all the businesses and all the regulatory for us. And at that stage, that was 15 years ago, I think it was. At that stage, you had business brokers and the real estate thing covered by the REAA, as it was back then, covered by their regulations. And at the top end, the accountants don't need to be real estate agents to sell. And yet the top end, technically they probably should have been some of these, I'm thinking like Cameron Partners, the big old guys. They possibly should have had the real estate licenses. So Minter said to us, they said, look, you can differentiate yourself by having an FMA license. So we're regulated by the FMA and an REA license. So we've done that as well. Yep. They said you'll differentiate yourself. So we were one of the first, if not the first, that did that in the mid-market space. There's been a bunch of follow-ons since. And the REA has has warned a few people acting without licenses in the market. And so they've had to go out and get them. But we did that, and it's a bit of a pain, but every year we've got to do our continuing education and stuff like that, pay our license fees.
Be an interesting room to sit in, knowing real estate agents and the difference of the conversation that you're having with people versus them. But let's move on from that conversation.
It's all online now, fortunately.
Okay, luckily. So FMA, Financial Markets Authority. So what are the things, just kind of super high level, is it like process and ethics? Is that kind of the role that they play?
Yeah, we have very little to do with them. It's not until you do something wrong, there's a complaint that you do hear from them. AML's been a real bear. Yeah. So we have to do that as well. So and we're AML audited every year, and it's.
Does the money go through your accounts?
No.
And yet you need to be.
Yep. We have to do KYC on all the clients. We have to do all that sort of stuff. We have to jump all the hoops. We have to audit it. They're really strict. Yeah. It's been expensive and painful.
Yeah, no doubt. AML, anti-money laundering, KYC, know your customer, for those that are listening are unfamiliar with the acronyms. No problem at all. That's my job. So let's go back to that process piece. Someone talks to you for a period of time. It could be 1 year, it could be 1 month, and then you put together the information memorandum. You engage with them. What happens after that?
Well, firstly, we'll by law under REA, we have to give them an appraisal. Okay. So that's an REA thing, not an FMA thing. Right. So we'll give them an appraisal of the business. It's not not to be confused with a valuation. It's not a registered valuation. It's an appraisal. Here's our opinion on what we think your business is worth. If you're selling a house, this is where this thing comes in. You know, they have to give you comparable sales and all this sort of stuff to give you valuation. So we have to do that as well. Got it. Unfortunately, it's not very easy to do comparisons on businesses because there really aren't any two alike. Everything's so different. So and also if you go online, you're looking for stats. Typically, the US puts quite a bias on multiples and so on. So we typically have to use our information, try and get New Zealand and Australian figures and all this, which is really hard. But so we have to do the appraisal. We do the appraisal. We give them that. We have to give them a proposal. So our proposal lays out all the terms, the conditions, all that. And if we get the go, we have a mandate agreement, which is just like if you're signing up with a law firm or accounting firm, you have to sign their mandate. And that, again, goes through all the legal bits and pieces. So with that mandate signed, retainer paid, we won't start until we have the retainer paid. We will then start preparing the information memorandum. So how we do that is we will give them a list of requirements. Basically, provide this sort of information. We'll interview them. Often we're only dealing with the owner and maybe a couple of the senior people. So you'll get information from them, publicly available, their website and so we'll build an IM. They're typically from 10 to 30 pages long. It's people. A lot of people refer to them as decks now. We don't. We still can call them the old information memorandum. So we prepare those. We do all the graphics, all that nice sort of stuff. We will also, depending on how we're doing it, we don't like to run big, broad processes. We typically are very targeted. I've got an FMCG transaction on the go at the moment. They were a client of one of the big accounting firms and had spent near on $100,000 with them and got absolutely nowhere. They came to us through a mutual relationship and a trusted advisor status relationship. They came to us and said, we knew this was going on, and so I said, well, would you like us to take a crack at this? And they was humming and hawing, we paid all this money, we did this. And when we dug into it a little bit more, how they'd gone to market had been very, very poor. So they'd it was an audit practice, right? So they'd gone out to probably a half a dozen or a dozen potential buyers. And we eventually saw that list and were horrified. We said none of those guys would ever buy it. We said, we don't know what the hell you've been doing. So they cancelled their mandate with this accounting firm, I won't mention them. Then they mandated us. And we said to them, here's a list of buyers that we think will buy this. And here's why. And we had researched every one of them, and we had details on type of thing. And they said, well, prioritise who you think are the best, the most likely. These top three, they're the three that we think are most likely to do it. And they said, okay, hummed and hard. It was a very reluctant vendor. Said, okay, you can go after those three. Go talk to them. And we said, the one at the top, we said, we'll buy it. We said, that's the one that we've picked, and that's the reason they're at the top. And here's why they'll buy it. And we started the process July, I think it was, and we got the offer all signed, countersigned in December. Wow. And we'll settle at the end of March, the financial year. So, and it's the one at the top.
Yeah, okay.
So
it's gratifying to be right.
We usually are. We usually know who we're putting together.
Okay.
Because we don't run big processes, we're very researched and very focused. You run a big process, it becomes very public very quickly.
Yeah.
And vendors don't like that. They don't want they want their staff to know about it. Because if you've got your business and you've got 20, 30 staff, 40 staff with you, they're like family to you.
Yeah.
They've been with you for a long time. And there's that whole the paternal relationship that the owners have with these people, and they genuinely do, and they want to look after them. They understand that they're responsible for 50 households' income, and they don't want to mess that up for them. They're very careful. So by going public, they're going to find out about that. It destabilizes them. It's like if your dad said to you, "I don't love you anymore," type thing. You'll take offence with it. So you've got now the owner of this is very careful not to put out. They are often very guilty about actually running the process, even selling the business, and they want to be very managed about how they introduce that to their staff.
Yeah.
By running a big process, you risk confidentiality leaks.
Yes.
So we try to keep it very tight. Not all processes are like that, but generally we know who the buyer and seller are.
Yeah.
We've already got that mapped.
And so a broad process, I'm imagining, is one where, at its worst, it's probably an email hits an inbox of someone who might be responsible for M&A. Could be the CFO, could be the CEO of the business, and there's an IM. Don't know if you'd be interested, but, hey, here's a business that you could be interested in buying, kind of thing. That would be a rough version of it. A targeted process, how do you do that? Is you kind of have relationships with people, or do you find out, you call a CEO and you kind of say, hey, this is a great opportunity that could be something for you?
All of that. I think even for the broader processes that we run, we don't just fire out random emails to a bunch of people. So we will generally know, if it's a trade, if it's a particular sector, we'll then look at the trades buyers who are likely to be buying in that sector. And we generally have built relationship with most of them. We're pretty active out there dealing with people. So we've got, all the contact lists and details and people and stuff. So we will usually send them a flyer. We have like a 2 or 3 pager, which doesn't mention the company being divested.
Okay. Anonymous,
So, it's not. And if there sparks some interest, with the CEO, CFO, whatever, we will then get a confidentiality agreement signed, and then supply the information memorandum and meet with them and discuss it and go through it and all this. Yep. Generally, they can sort of get a flavour from the flyer and go, it doesn't sound like me. And every now and then we have a process we can run which isn't confidential, where we can supply an IM. Doesn't happen often.
Right.
I've got one on the go at the moment like that.
Trade sale, trade buyer, that means someone from the industry?
Yeah, so when you get to the larger businesses, sort of a 10 mil plus EV, you really are out of the reach of most private buyers, unless there's some reason for it. So a trade buyer is the likely buyer. If you're selling a FMCG manufacturer, you're going to try and find another FMCG manufacturer. Often as well, they might pay a premium for the particular business because it's got strategic importance to them. So you're just trying to match that up. We tend to know, if you take like FMCG, I'm beating up on this, but FMCG, certain manufacturers just don't like frozen. So, if you've got a frozen business, you don't take it to them because they just don't want it. Yeah. And so you try to match it up. And, we've been at it long enough and, met enough people and kind of mapped it that we have a good feel about who a buyer might be. We have done a few roll-up type transactions where you will use a cornerstone in a particular sector and then you're trying to roll up or, acquire other similar players. Now, that's an acquisition strategy rather than a divestment strategy, but it's the same thing. You're looking for trade partners or trade players in that sort of role. Yeah.
Why would someone do a roll-up?
Economies of scale, mainly. You also geographic reach. If you say I'm in Auckland and I want to be also in Wellington and Christchurch, so you go and acquire companies in those areas. So there are various reasons. We did an education roll-up a few years ago, just try and get some sort of synergy into the education space. That became Aspire 2, which is still out there.
Yes.
It was supposed to be an IPO, but it ended up getting sold to private equity before the listing.
So back to the targeted process. So there's a call, there might be an email, they've signed a confidentiality agreement, they've received the IM. What kind of happens from there?
We start working with them. They'll start asking questions. We'll have Q&A sessions. We'll get at some point we bring the vendor in. Often we don't at the beginning because we could be fielding 10 or 20 buyers. So you don't want the owner to go through all that. So we manage all that sort of process. We ask for we generally will get written questions. We'll provide written answers. The objective for us is to get them to make an offer. Now, an offer for us is typically what we call a non-binding indicative offer. In NBIO. So that's where we receive an offer from a buyer. It states their terms, what they're paying, whether there's any earnout sort of stuff, any other bits and so on conditions. Now it's non-binding, except there will be a confidentiality clause in it, which is binding, and often an exclusivity clause, which is binding. But the rest of it isn't. So with that, agreed by both parties, then we go into due diligence. And that's when the buyer will ask for a whole bunch of information on the business, financial, legal, employment, supplier relationships, customer contracts, all those sorts of things. Anything you think might be necessary for them to see in order to be able to validate the business. We manage that process, and we have what we call a VDR, a virtual data room. In the old days, there was actually a data room where books and files were all put in. You could come in and look at things, but you couldn't take it out. So that was the old.
I wonder why they were called data rooms.
It was actually physically a room.
It's interesting. So there was boxes of files. I love it. Wine boxes.
Yeah, pretty much. And you couldn't take them out.
Yeah, wow.
They were there because that becomes the record. So with a virtual data room, it's all online. It's in the cloud. We have our own that we built, and it's secure. It's got all these layers of security and so on. And with the documents that go into the data room, they're then accessed by different people, whether it's the buyer, their accountants, their lawyers, all that sort of stuff. We track all that. We know who's come in and out of the thing. We know what they've looked at, what they've downloaded, but they can't change anything in the data room. Right. The data room files are locked by us. Yes. So we're the only ones who have had access to put things in or out of it. And once it goes in there, it never is changed. We run what we call a control sheet process on it, so we know what's in there. And at the end of the process, when the business is sold and settled, we roll that all up onto, believe it or not, onto a flash drive, it'll dongle, and we give that to the lawyers and the accountants. And there's your final record, all the due diligence. So if there's ever a dispute later on, if somebody says, oh, I never saw that during DD, we say, well, yes, you did.
Right. Yeah.
Here's the records. So we run the VDR. In and out, we get involved in a lot of the Q&A sessions. There'll be lots of meetings. There's site visits usually, and then they'll get into employee interviews and so on and so on.
Yeah, got it. So optimal scenario is that you've got the long list narrows down to a short list. That short list, you'll ask them for the non-binding indicative offer. In an ideal situation, you'd want to end up with 3, 4, 5 NBIOs.
That would be nice.
Yeah, that would be nice.
It doesn't happen.
Yeah, okay. So ordinarily 1, maybe 2 offers.
Yeah.
Is that kind of what happens?
Yeah, generally you might have circling and buyer circling, and you'll be talking to them about where they see the value, and so you have a good idea where they're going to come in at. Getting 2 NBIOs at the same time is rare. You'll get one come in, buyers will usually put some pressure on you for time. Yeah. They don't want it to be gazumped on it. They'll have an exclusivity clause in there. So if you accept that, you can't talk to any other buyer.
Right.
So the clause could be 60 days or 30 days or whatever it is. So you have to be dealing with them exclusively. Yeah. And you've got to shut down all communications with anybody else. Yeah. You can't even discuss anything. Getting 2 of them on the table, we've not had that often.
Yeah, okay.
It's not like a property selling your house thing where you get multiple offers and all this. It just doesn't happen with these larger transactions. Finding multiple buyers is hard. You'll have multiple interested parties, but you've got to push them over that past that point to make an offer.
That's part of your magic, right?
Something like that. Yeah, that's what we try to do. That's our job, is to handhold them through that process.
Yeah. Apologies for the interruption, and thanks for listening to the show. These shows take resources to build and put together. We have a team of producers, we have some promoters behind the scenes, and of course we have the guests that generously give their time to come on the show. My only ask of you is that you go and check out my website. I advise founders on how to build value and how to navigate the exit process successfully. We have a diagnostic on the website. There's an ebook that I've written. There's a free chapter of my upcoming book, Wantrepreneur, on there. So I'd just urge you to take a couple of minutes and go and check out joshcomrie.com. So back to those 2 key numbers. You've got the EBITDA, the earnings, and then you've got the multiple of those things. And so those are probably a couple of key terms that would be captured in the non-binding offer.
Absolutely.
And so then DD would kick off following that process, like full DD. That's the period of exclusivity that they would have to be able to make sure that they're investing the time and the effort to go through and evaluate the company properly.
That's when they start spending money with accountants and lawyers. So everyone's very careful not to spend too much in the initial phases. But once they've made that decision, once they're spending money, it gives a comfort to everybody that there's a level of commitment.
Yes. In how many instances, proportionately, has the offer been markedly changed from the point of the NBIO to the point of the actual sale and purchase agreement?
It gets refined. I think just about always gets refined.
Right.
You wouldn't really see a heavy renegotiation of the headline. It does happen. Often, if they want to do that, they've found something and it's generally negative, right? And which will often tip the deal over, regardless of the price. Right. They'll find something they just don't like, and they'll go, doesn't matter whatever price you want, I'm just not interested. Yeah. So that's not really happened to us. We've been very careful, I think, we're quite careful with who we take on because we are at risk on
your reputation, right?
Well, no, all our success fee.
Yes, of course.
We don't get paid if it doesn't close. So if we can spend a lot of time on a deal and we think the business is shonky or has some skeletons or whatever, well, it'll never settle. Yeah. And so we've just wasted a lot of time on it. Yes. So we do a lot of pre-qualifying on vendors as well, on our clients. We clearly meet with them, do our own DD. Yes. On the directors, on the operators, on the CEOs, all this. So we do DD on that. Okay. We don't take everything on. Yes. We've turned turned more away than we've taken on.
Interesting. What are some red flags for you during that initial DD phase?
financials, when we look at the numbers, we just go, these just don't make sense.
Right.
We have, I'm not an accountant, but we got two of our team who are accountants.
So like weird gross margins and profit all over the place and, that sort of thing?
There's often a mixing of personal and business.
Yes.
That's a huge red flag to us.
Yeah.
And so one advice to any business owner is keep them separate.
Yeah.
Don't mix your personal stuff up.
Yeah. Yeah.
So we see that a lot. We'll see potentially issues with staff. There could be PG stuff that we could see and that could be coming. They may not have done a few things correctly. We haven't really had any problems, I think, with any sort of tax or GST type issues. We kind of expect them to be paying the IRD.
Yes.
So we don't check on that so much. Any issues like with any fines or government regulatory sort of, impacts on the business. They've done something wrong and kind of buried it, and you pick it up and you go, well, you're never going to recover for this. Killing a customer is always a good thing. It's never a good thing. If they've done something like they've had, if you're an FMCG, if they've had food recalls, they've had issues with food and all this sort of stuff,
right,
then you kind of go, well, your processes are probably pretty shonky. If you haven't been able to keep your hygiene standards up and you've done something like this, wonder what else you're doing.
Yeah.
But often you can just smell test them. You get to know.
Yeah, yeah. Litigation, do you go searching for that past and current? As in, are they the subject of any litigation? Or
definitely. Yep.
Yeah.
So staff and personal grievance claims are probably the biggest trip up on
Right.
that they've just done things wrong.
Yes.
They've underpaid staff
Right.
intentionally or knowingly.
Yes.
They haven't been recording holiday leaves and all entitlements and all that sort of correctly.
Yeah.
There's usually quite a big holiday leave entitlement sitting on
On
books.
balance sheet, yeah.
So that's really important to take care of that. And if you look at a business that doesn't have that on their balance sheet, you kind of go, why?
Right.
Well, we just haven't been allowed for it. Well, you need to factor for it because that actually affects the value of the business.
Yes. Yeah. So just repeating back, the things that are standouts for you, the things that are concerns are that if there's a blending of personal expenditure and business expenditure, there's some oddities that sit around in the financials. There is not enough leave sitting on the balance sheet. There's any PGs that might exist against the business. There could be some litigation that's around. Those were the kind of the headline things.
It's blending them as well. You can tell when you start looking at a business as to how well run it is.
Yeah.
Systems and processes important. Is one red flag is it's all sitting in the owner's head. All the whole business is there, the supplier relationships and all this. Now that doesn't mean it's not a good business. It just means that there's work to be done to get that out.
Yes.
If somebody's died as well, you've got a business that you're trying to, they want to sell because an owner's died and it's with the family and,
Yes.
you kind of go, well, where's all the expertise that's gone and so on.
Yes.
We haven't had a situation like that. We've had a couple of cancer scares with different buyers and stuff like this. One big red flag to us, which is happening more and more now, is profit warnings that they're just not hitting numbers.
Right.
That you've seen a constant sort of growth and all of a sudden they've dropped off. And then they come to you and when they sell a business, you kind of go, well, you really need to get your numbers back up again.
Right.
So that would cause us concern to take that one on.
Yeah.
It's a very hard story to tell. And often the owner expectation on value is a little bit overinflated as to what the market would actually pay.
Yes. We've just come through, hopefully, in the past tense, a recession. And so I've no doubt that you're fielding calls from people that are kind of of a certain age and stage perhaps, or that their business has not gone as well over this period as they would have hoped it to have gone. So what's the advice that you give folk that have had that? First question, is one blip, so let's say we've gone, I'll just make some numbers up here, $1 to $2 to $2.50 to $4 in profit over time, and then we drop back down to $1 again over the last year because there's been a tough year in business. What would your advice to someone be in that situation?
The problem is that we've had a fairly unique set of circumstances in the last number of years. COVID has really messed things up.
Yeah.
So a lot of businesses came through COVID. They had that a COVID hit, a lot of the businesses did really well over COVID, especially food producers. They did really well, but they all came off again afterwards.
Yeah.
So then we went into this recession. We saw interest rates going up. You had a lot of these businesses a lot of people had taken on additional debt when it was cheap. Thought, yeah, wonderful, wonderful. But of course now they have to pay more for that debt. Yeah. So there's a fairly unique set of circumstances at the moment. And giving advice to an owner, it'd have to depend on their personal circumstance. Like if they were in their 70s and they just retired, wanted out, and been having health problems or whatever, I just say you can't wait. You just have to do this.
Yeah.
We can provide information as to why there is that drop in revenue or profitability. If it's explainable, that's great. If it's just we don't know, well, that's a problem. So if they have to sell, we will work with them. But if they don't have to sell and their numbers are right down, we will generally tell them to go away and come back in a year or two, just trying to get those numbers back up again.
Yeah.
Because they'll be selling cheap and they'll be leaving, they won't be getting what they probably deserve for the business if they think they can recover that profitability. Just depends on the business. Obviously, there's a lot of businesses that sort of cycle out, like printing businesses that aren't worth anything anymore. The value of those has dropped dramatically. That's not a recoverable sector. That's a sunset sector. But they buy and sell.
Yeah.
They trade.
Yes. Okay. So I'm a business owner. I've been in business for, 10 years, for example, and I'm kind of looking into the future going, I'd just not imagine myself doing this in 2 or 3 years' time. What would be the advice that you would give someone? This is generic, obviously, but the top kind of 3 things that someone could do within their business so that when they turn up to see Greg in a couple of years' time and go, hey, Greg, I'm really interested in taking my asset out for sale. What are the top 3 things, for example, maybe more, that you would say to them that they should really get in order now beyond that sorting of the books out and getting the personal stuff out?
Beyond that?
Outside of that.
Well, the top thing I'd tell them, or anybody, is make sure you've got a good accountant. So, but that is part of getting your books and all this sort of stuff. The other thing to say to them is, well, why are you selling? Why do you want to sell? I don't want to do this forever. Well, what are you going to do when you sell it? Do you what age are you? You're 40, you're going to sit on the beach or you're going to do something else. Understand that you will be giving up an income stream. You'll take some capital out of this thing, but if the business is returning a couple of mil EBITDA to you, you're taking out a decent check. That will stop. Understand that if you're that young, you're then going to probably say, well, I want to do something else. I want to start another business. And startups are very dangerous.
Oh, horrendously.
Right. So we all know that. So if you've got a good business, you might be a little bit bored with it. It might not be sort of that exciting to you anymore. You've been doing it for 10, 15 years and you just think you want to change. Think really long and hard about that.
Yeah.
Maybe selling is not the right thing. Maybe you want to acquire something. You want to grow your business, buy something else, ramp it up, because also depends on the type of business. If you're still a smallish business and you're not corporatized, it has a different set of buyers. But if you go and buy something else and you put it together and you grow those businesses, then you can corporatize that. And now you've got a business where you really don't have to be involved in it. Also, you could look at bringing in partners, an investor partner, somebody to work in the business, so you could free your time up. So you still have ownership and income from it, but you're not spending all your time on it. So just really understand what your personal goals are, what your personal drivers are.
Yeah.
Do you want to retire? If you're 70, then fine. But if you're 40, do you really want to? Unless it's something you want to go and do. But just understand the motives for that. We've had clients before. We had one recently that we went through, and I can't tell you the name of them, but there was a husband and wife team, and they had a business that was going really well, wanted to sell it, and so we were running a process on it, and they just sort of woke up one morning and said, "Oh, we don't want to sell it anymore," and which is fine. It's kind of annoying for us because we don't get paid on this, but so before you start that process, which is very it's very time consuming for an owner to go through the process, and it's very disruptive. I'd say to them, think really long and hard about what your objectives are before you even start the process, and come back to us in a year of time. You know, and often, and I've got my diaries full of things. I got to call so and so, say, give me a call back in 6 months. So do that, and I call when I touch base with them to see where their head is. And often they'll having bad days. I'm sick of this. I want to sell this thing now. You go, no. Calm down. Let's go for a coffee next week and just see where you are. And you go for a coffee with them next week, and I sold better. And I had a good week. But people are looking for succession planning and exit. Like I said at the beginning, you should always be looking at you preparing your business for sale right from day one. So most good owners are like that, and they understand they'll want to exit. It's just really when.
Yeah. One of the things that our research dug up is that your role is part psychologist, and that's what you've actually just said there.
Yeah. We also call ourselves wedding brokers. Marriage brokers.
Marriage brokers.
Because we're putting people together.
Oh yes, of course, yeah. Because the business is intrinsically made up of people, processes, and technology. Customers and agreements sitting around the outside of it. So that's interesting. Marriage brokers. Yeah, so
you're putting the parties together, and and especially with an earnout process in there, and maybe a partial acquisition, it's really important that there's good chemistry between the partners.
Yes.
And no business at that sort of level is here's the keys, it's all yours, I'm out. Yes. No business is that. There's always a transitionary phase, and made even more difficult or more important when there's an earnout. But everybody who's buying a business of any scale wants to have continuity from the previous owner. They want them to, for a year or so, to be at the other end, at least the other end of a phone, and still be sort of invested in the business like that. So without any chemistry there, it's not going to end well. So it's really important to have that. And so we spend a lot of time with the parties, making sure, little things, going out for dinner with them, and, little bits and pieces like that, and just getting to understand how they all work together and how that they can work together.
Yes. One of the options you mentioned along the way there for the founder is, as opposed to necessarily the sale, is the corporatising. And so by that, what I would interpret that to mean is having effective succession plans in place, having good processes, some automation where it's necessary, perhaps a governance board, effective executive team, great reporting. Have I missed anything there?
There wasn't really. Getting it to that next level is quite a big inflection point for a lot of businesses, and especially when you've got an owner who's got the majority of the shares, all of them, and they typically have grown the business up without any external advice, no governance board. They'll be on the board, and maybe their accountants or lawyers are on the board as well. So they typically are really are one man bands, but still with a business with 10 or 20 million. It's really important, I think, to get at least an advisory board around, but more so a governance board. And especially when you've got a larger share registry. If you've got a single owner, it's a little bit easier. But if you've got multiple sort of shareholders in the business, you really need that governance board around in place. And that's the kind of the growth thing where you may have an ESOP in place, you may have sold bits of the business, you have reason for having a larger share registry than just a single owner. And so you're getting to that stage, that's corporatising the business, it's getting there. And all your systems and process and technologies and all that's really, really important. ESOP's one of them. ESOP is businesses here in New Zealand don't incentivise workers, staff.
Not very well.
Very poorly. The one I was talking about earlier, the one that we signed the NBIO in December, the buyer is Australian, and they were quite surprised that there was no ESOP and no incentives, no bonuses and all this. So they've sort of been clear saying, well, when we get in there, we will be implementing those things. And they're a corporate buyer, so their expectation is these sorts of things, whereas the buyer, our client here is mid-tier sort of business, and they've been very much running the business single shareholder without having to do those sorts of things, and that whole paternalistic sort of ownership of the team. It's also quite a legacy way of running a business.
Yeah, I agree completely. Yeah. Not everyone's kind of cut out to be the business owner, and there's a lot of great people around that represent individual contributors. And so why not share some of the success and the fortunes that you've been able to build with those folk?
Absolutely.
Yeah, that's my mentality.
Well, also we see a lot of businesses with business development staff that aren't performance incentivized. It just doesn't make sense.
Yes.
You got a salesperson who doesn't get more for selling.
Yeah. Why would they, do the extra 5 hours a week to get another 30% of business kind of thing? So
exactly.
Yeah. Let's talk about debt. So this is something that you've been kind of talked about in blog and other forums. Debt is not just a tool; it's an enabler for strategic growth, but only if you structure it correctly. And those are your words. So let's talk about the use of debt in both growth of a business, but also in the M&A process as well.
In the business growth, turn around the other way. If you talk about, look at what the private equity firms do when they buy into a business. They will write a check and have 2 or 3, 4 times that in debt into the business. That's kind of a rough model, and depends on the cost of debt at the time and so on. So they will always leverage their equity. Of course, they're not looking for taking the profit out immediately. They'll let that run and stuff. So that's how they are able to acquire larger businesses and spread their fund wider. So from a purchaser's point of view, if you're buying a business and say it's a $20 million business and you've got $10 million in equity, so you're going to need to debt fund the rest of it. It's what it is, unless you'd want to buy it all equity, but you wouldn't do that. From an operator's point of view, having debt in the business allows you to do more. To increase your capital equipment. You take, say, a trucking company. So trucks are expensive. So you want to have a debt book for your trucks. You might have a couple of $1 million sitting there with the bank, secured by those assets. Allows you to be able to have more assets out there, utilize those assets, they're working, generating income, servicing the debt and providing a bit extra for the profit. Yeah. So debt is important in a business. If you try to do things debt-free, you are limited to your equity, your capital. You can't grow outside of that, and it means very slow growth. So your return on investment on the assets or capital equipment that you're using debt to buy needs to be higher than the interest you're paying on debt.
Yes, got it. I'm curious, we're a nation of obsessives about residential property.
Right.
And so often you find that people do well in business, and the asset class that they tend to pour money into is residential investment property. I don't agree with that fundamentally, by the way. Yeah, I wish they wouldn't. I own one house, it's the one that I live in, and a bunch of other industrial property, which is an asset, and there's businesses and you pay tax and all these sorts of things that provide economic support and economic growth. But do you often see that when you're looking at a business, that they don't carry debt inside the business, but they carry personal debt sitting on residential or otherwise kind of property?
Yeah, we do actually. We don't typically look at what their personal situation is. Most people don't want to just disclose it. You've got a house, a couple of houses, or whatever. So we don't talk about what debt load they've got on it because the business sits separately. But yeah, a lot of New Zealanders are happy to have debt on their on residential property, but struggle with it in a business. And we do get some of the older business operators who just don't want debt or have had debt. And if you go back into the sort of the 20% interest rates and stuff,
70s, 80s,
My first house I was paying 19.95% interest, and it's horrific.
Yes.
And you get a lot of people come through that environment and say, I just don't want that level of debt. And they get to older in their life and they run their business similar to the way they run their personal stuff is, I want to be debt free by the time I'm X, pick a number. And so they want that in their business as well. I read a study or survey a few years ago, and it said that 86% of New Zealand SME business owners aren't interested in growth.
86% are not interested in growth?
Yep. Of SME owners.
Yeah, of business growth. Wow, that's remarkable.
It's ridiculous, isn't it?
Yeah.
But so they've got to a situation, we all talk about this 3Bs thing, the batch, the BMW, and the boat.
Boat, yeah.
Right, so everybody's got this. Once a lot of them get to that stage, they've got the 3Bs, they're quite comfortable, they've got a good income and all this, and they're reluctant to take on risk in a business. And they're quite happy with what's going on. Their staff are protected. They've all got jobs. They don't feel that they're going to risk anything. if they are to, if they sort of see an opportunity that requires them to put more capital in, via a debt a facility or whatever, that comes with risk. And they're very risk averse, especially when you get the little bit older owners. They go, well, if I was a younger man, I'd be doing this. And we hear that all the time. So that's the 86% of businesses where the owners are comfortable.
Yeah, wow.
They just aren't interested in growth because of the inherent risk that comes with that. You often see businesses in liquidation because they grew fast, they capitalized the business well, there was debt and all that sort of stuff, and something went wrong. And generally it's like they've lost a big customer. So a big customer, and it happened a lot during COVID. We lost a lot of customers, and a lot of Chinese customers supplying to, they just stopped. Supply chain stopped. They went and got stuff from elsewhere. So if you've scaled your business up to provide a product or service to this customer and they stop buying from you, you have a problem. You've got staff, you've got facilities, you've got debt you can't service. So a lot of owners are very wary of that and very, very nervous of that. And often it's that sort of business where you've got a founder who's come off the tools maybe and has grown a business, done really well with it, but isn't very financially literate and may not have the big macro understanding and is risk averse. They've got their house, they've got their kids in school maybe still, and staff to look after. So they just don't want to challenge that.
Yeah, understood. It's interesting. Someone who's come off the tools, it reminds me of the Malcolm Gerber book, The E-Myth, and he talks about often an entrepreneur, it's entrepreneur myth, is an entrepreneur for 5 minutes, and then they'll revert to the form of type that they came from, and it could be a salesperson, engineer, like a technical person, or what's the last one? Or a manager. And so that's the typical background. I'd add product person to that these days, being tech heavy, but then there's not too many other backgrounds, and so they default to doing that thing really well, but then insufficiently filling in the other areas of knowledge gap that they have, and so consequently their business might suffer across those spaces. But to wrap back around to the point here, what you're saying is good debt in a business is a good thing to have.
It allows you to leverage your capital.
Yes.
You for every dollar of equity you've got, you could get another $2 of debt.
Yes.
And banks are happy to lend to good businesses.
Yes.
It allows you to grow your business, but you have to, because you're spending somebody else's money. You have to be careful with it.
OPM, other people's money.
Yeah, it's not yours until you've paid it back.
Yeah, exactly.
And there really is that a lot of reluctance in New Zealand to take on debt. Aussies love their debt.
Right.
Australians are more brash in business. Kiwis are very conservative. It's kind of our heritage, I guess.
Yes, it is.
But we are very conservative. We don't like risk. We don't like to usually be too flashy and flaunt wealth. It's just kind of who we are as a nation.
Yep, I agree with that. I'm going to go back and talk about the legal thing a little bit more.
Yep.
Again, a quote from Greg, an M&A lawyer should be more than a legal shield. They should be a strategic partner in value creation.
Absolutely.
How do they go about doing that?
Value creation, they help get the right outcome for the client.
Got it.
But part of that is, you asked earlier about structuring sale and purchase agreements and earnouts and how that's sort of put in place and governance and so on. A good lawyer creates that value in that the sale and purchase agreement. That's the most important thing they're going to do in that transaction is get that. Can I use the word spa?
Yeah, sure.
Get that spa right, and so that it's got to be commercially viable, feasible, or acceptable for both sides as well. We get a lot of lawyers, small lawyers, will become very confrontational in negotiation. I've seen them slam tables and throw things and all that sort of stuff. Whereas you get a really good commercial lawyer, unflappable.
Right.
He doesn't get upset.
Yes.
And understands what are the right points to argue and what are the right points to concede. So it's really, that's the value they create there is, don't worry about that. That doesn't mean anything. This is what we need to be focused on. But if you get a lawyer who doesn't know what they're doing, they'll be focused on everything.
Right.
And it'll often kill a deal.
Yes.
So an M&A lawyer is critical.
Yes.
We will even work from on our the other side of the table trying to get them to get a better lawyer.
Wow.
We'll give them advice. Say, look, as a buyer, you really need to be well advised. Who's your lawyer? They don't know anything about the space. Go talk to so and so lawyers. So we'll even try and do that, influence the other side. They don't take advice necessarily, or have to take advice, of course.
Yes.
But we know that having a good M&A lawyers on both sides is very, very valuable.
So again, I'm a 10-year business owner. I'm looking at going through the process of sale with my business, and I'd like to evaluate lawyers. I've got a person who's been doing my what did you call it? Leases,
wills and leases.
Wills and leases. And so how do I evaluate a lawyer's competency in this space? Is it the classic kind of tell me about the experience that you've got kind of question, or is there something different that you do?
Yeah, I think there's you ask the lawyer, what have they done M&A? Have they done transactions like this?
Yes.
And they should be honest with you. They should also talk to us and get our advice and input on what they should do, who they should get advised them. Look, to be honest, if we haven't heard of that lawyer, they're probably not an M&A lawyer.
Right.
It's kind of the way it is.
Yes.
And they say it's so and so from High Street in Cambridge or something. I'm just picking something. Then you kind of go, maybe not.
Yes.
So we try to influence that.
Yes.
And we will do our own DD on the lawyers as well. We'll look, and if we think that the lawyer's going to have issues, we will advise our client. At the end of the day, it's their choice, though.
Yeah, and I need to call this out for people that are listening to this. You would influence that with the intention of getting the best outcome for you and the vendor, because that would represent a better outcome for you, and so therefore it's by far the best interest for everybody.
Oh, absolutely.
Yeah.
But it's also having a good M&A lawyer on both sides.
Both sides,
so
yeah.
both sides get the right advice.
Yes.
And two good M&A lawyers who are commercially astute will sit across the table from each other and nut this thing out really quickly. A lot of people think that the big law firms are expensive. Well, they are by the hour, but they spend less hours on it because they know what they're doing.
Yes.
They don't have to learn on your dime.
Yes.
So these we've seen some of these horrific bills from some of these suburban lawyers who have just had the whole team working on this thing for months trying to nut this thing out, and they have to learn it all as they go.
Yeah.
And if they've on the other side of it, if they've got a highly qualified M&A lawyer, he'll run.
I'll just pull them apart.
Yeah, and
yeah.
So it's not just on our side. It is a better outcome for everybody. A better outcome for us. Better outcome for our client is the main thing. Our fiduciary responsibility at the end of the day is to our client.
Yes.
So we're trying to get the best outcome for them.
Yeah. What are some hidden risks in spas, for example, that many founders could overlook?
That's a difficult one. I mean, there's always hidden risks. There's always risks. I wouldn't say hidden. Everything's very transparent, and it's in there in the document. The complexity around earnouts is really key. But generally, they shouldn't be too. A lot of the spas can be quite boilerplate. It's just transition. It's how the IP is being handled, and so on, so on, so on. So it's not really the spa shouldn't be difficult.
Yeah,
it shouldn't be a deal breaker.
Okay. Are there things that you've observed which people kind of, occasionally or regularly overlook as key deal terms when they're putting together agreements from the inexperienced lawyer, for example?
They often leave out approvals. You might have third-party approvals on things. For example, if you have a supplier relationship with an offshore company, you may have to get their approval before you can. Because businesses are sold. There's two ways of selling a business. One is shares and one's assets. Yeah. So if you're selling an asset, if it's an asset sale, there's an effective change of control. So there's certain parties that will have rights over that effective change of control that they could challenge. So it's getting those things all nutted out. We've seen businesses, lawyers that'll sort of sign sale and purchase agreements when they haven't figured that out. And things unravel once a business is settled. Not one of ours, of course.
You said that there is two forms of selling a business, selling of shares and selling of assets. Could you break that down for us?
If you're selling shares in a business, every business has, every limited company has a certain amount of shares issued.
Yeah.
It's really up to whatever you did when you set it up or what you've done. So when you sell a business and the shares in a business, you're selling that as a going concern of the entity. It's got all that. It comes with. But the problem with that is that comes with all the history. So what happens then in order to be able to protect the incoming owner from anything that might have happened in the past is what we call warranties and indemnity insurance, warranties and indemnity clauses, and you can get insurance for that to cover that. But so the warranty and indemnities section of a sale and purchase agreement, that's when you're selling shares, is key to get right. It's very, very can be very, very complicated, and this is where an M&A lawyer. I couldn't write those things.
Yeah.
There's a lot of boilerplate that goes into it, but it's just to protect a purchaser. When you're selling a business for assets and IP, you are buying the assets, and IP is an asset. So you're buying the business, whatever else is included. Typically, they're what we call debt-free, cash-free transactions. So all that's taken care of at the time of settlement. The cash is in the business, stays with the vendor. So those are businesses you'll set up a new company, or you'll roll all that sort of stuff into a new company. You'll create your new bank accounts. You'll have new relationships with suppliers. You also have to fire and hire the staff. Because you have to bring them in on new contract terms. Generally, the sale and purchase agreement will specify how that's done. Generally, you bring them on exactly the same terms, and you'll grandfather their leave provisions and things like that.
Got it. I was involved recently as an investor in a significant transaction in New Zealand, $300 million, and it was a asset acquisition. And there was a nomenclature term which was used by the American acquirer, which was contrary to what we use in New Zealand, which was really interesting. And so they wanted to buy the IP of the business and the revenue stream and then take the staff on as well, but they didn't want to have anything to do with the historic company from a share sale standpoint. For whatever reason, there was nothing unusual or sketchy going on. It was just how they
just don't want it.
Yeah, they just didn't want it. That was how they went about buying businesses. But they kept on referring to the distribution of funds as dividends. And in New Zealand,
it's different.
It's very, very different because a dividend has tax attached to it, whereas a return from an asset sale in New Zealand, we don't have capital gains tax, and so an asset sale is a very, very different situation. So we had to continue to correct those folk until they came back around, and then everything was kind of put in the right nomenclature, because otherwise it would have had a horrendous tax liability for those of us that were receiving the.
How were they using what context were they using dividends?
The distribution of the funds that were left over once there was the assets had been picked up. It was a really weird thing.
The goodwill sort of component.
I think it may have been. Yeah. It was a number of us had to call it out along the way and then called it out again because we're like, do not use this word.
No, you would have been hit by the IRD for that one.
Oh, 100%. Yeah. And in incorrect context as well. It wasn't like we were trying to evade or avoid tax in any way, shape, or the imagination. It was a buying of a business, and so therefore there's no tax attached to it. It was weird. It was very, very weird. What deal structures have you seen that have gone wrong? Is this like a classic situation that you've seen that's gone wrong?
You mean post-settlement or during the negotiation?
Negotiation.
MBOs, management buyouts.
Yeah, okay, tell me more.
They're the hardest to do. Problem with the management buyouts is you're negotiating with your employees at this point. If it goes pear-shaped, you affect relationships quite significantly. We have worked on one as in a service business, consulting business, and it's an MBO. And because consulting businesses is so reliant on the staff, on the people in the business, if you get that wrong and upset your staff, you now can risk your business.
Yes.
So it's very dangerous to get into an MBO. A lot of people throw that out as an option quite early in the piece, but some businesses you just wouldn't want to do that. That's probably the one that I have most concern about getting into a transaction as an MBO.
Right.
Generally they need to be employee-led. In other words, they need to go to the owner first and say, we want to do this before the owner is looking to exit.
Right.
Because then you've got an owner who says, well, okay, tell me what you want to do.
Right.
And rather than the owner says, I want to sell, and this is the process I'm going, if you want to put an offer, and you can too, because it's straight away you've created a little bit of animosity there.
Yes.
And risk. We don't like risk.
Yeah, understood. It carries consequences.
Yes, absolutely
if it goes wrong. Yeah. So you've talked a bit about the founder agent stage, as I refer to it. The 40-year-old founder selling the business. What are you going to do next? So what's your view on kind of the counselling, the advice, the suggestions that you give to people about life after exit?
Why are you selling? What do you want to do with yourself after this? You know, if you're in your 80s, it's kind of fairly easy. But if you're a younger vendor, why are you doing this? Why don't you just, enjoy the business? Often you'll get business owners just feel that they are at max on the business. They don't have the knowledge set to grow it further. They don't have the skill set. They feel that and often this comes from, being a single founder. You don't have a board, you don't have a mentor sort of set up, you don't have anybody to talk to. It's very lonely to be the owner or CEO of a business like that. So what we will tell them in a situation like that is get some advice, get an advisory board, get a couple of people around you to throw things off. And often when you do that, they'll look at this and they'll look at the business in a different light once they've got it in place. They go, I'm actually enjoying it now. Right. And so we say, that's good. So just wait. Grow the business, do it a little bit, get a bit more, increase your value. Because if you sell it, if you're 40 and sell it, how much golf can you play?
Yeah.
But somebody may have something else. They'd say, well, I'm done. I'm out. I want to go and make clay pots. That's what I want to do the rest of my life.
Yeah.
Fine.
Great. I'd probably ask them, have you got any experience making clay pots thus far? Or is this an imagined amazing hobby that you're going to turn into a vocation or something?
It doesn't have to be a vocation. It just has to be a hobby.
Yes.
Just, I want to go do something I enjoy. I really enjoy something completely different. I just want to make pots.
Yeah.
I'll give you an example. My sister-in-law was senior exec at Microsoft for many years. And she's been there 30 odd years or 20, nearly 30 years. She's just retired from Microsoft. She's younger than my wife, so I think she's not even 50 yet. She just retired from Microsoft and made a whole squillions of money and all this. And so she wants to make pots.
Literally.
So this is where the example came from. This is a true thing. She's bought the potting wheel and all that sort of stuff. So she's sitting in Seattle making pots.
I love it.
Completely different. She said she burnt out at Microsoft, just too hard, too much, and she wants to make pots.
Yeah. Good on her.
Yep.
I wonder what they're like.
We'll have to see.
I hope they're wonderful. We shall see.
Yeah, we shall see.
Yeah.
I guess we know what we're getting for Christmas.
Yes, yes. You talked about risk. So in terms of mitigating risk, what do founders not think about until it can be a bit too late?
In the business sale process or just running the business? In the business sale process, they often will come to us and want to sell quickly. And the biggest risk is to try and do it quickly.
Yes.
It's like, it takes 9 months to have a baby. It'll take 2 women to have a baby. Still 9 months, right? So you can't do things quickly. You still have to go through. Am I allowed to say things like that these days?
We're going anti-woke these days.
Oh, good.
Because Trump has just gotten into the White House. So I think we're okay.
We're good on that.
Yeah.
Good. So it's giving yourself time. You really need to allow 2 years. Generally, we can get it done quicker. Yes. But you should allow 2 years and get your head around that.
Right.
And because if you go into the process and think, I'm going to knock this out by the weekend, well, you're not.
Yeah.
Unless there's some really odd reason or you'd give the business away or something. But generally, we would say allow 2 years.
Yeah. Okay.
And also, if you try to go too fast, you put a lot of stress on the business owner because it'll take up a lot of their time.
Yes.
They get burnt out over the process. They don't like it. So we just try to, because they have to keep running their business.
Of course.
So you're just trying to mitigate their stress levels.
Yes. Yeah, one of the things that I've seen happen with people is that when I was first approached about being interested in selling my first business, we had a investment banker that was in the same building as we were, and we were friendly. So I went and had a chat to him, and I said, what should I be thinking about now? And he said to me, the single most important thing I can tell you right now is do not take the eye off growing and running your business. Yep. Because what will happen is that this may not go anywhere, and normally they don't go anywhere. And so you will end up in a situation where you've spent 3 or 6 months being consumed by this process over here, and your business has suffered as a consequence.
Absolutely.
And so you need to get it back on track again.
Absolutely. Focus on your business. This is why allow yourself time for the process, but get an advisor.
Yeah.
Advisor takes 90% of that workload off you.
Yes.
Lets you run your business, and a good advisor is very understanding of your time and isn't expecting you to jump every time they ask something.
Yes.
So we're very careful in how we and on not to put pressure on our clients.
Yes.
If they say it's going to be 2 weeks before they can get you this stuff, yep, fine.
Yes.
But if you're trying to run a tight process, that stuff becomes pressurized and stressful.
Yes.
And so just allow yourself time.
Yeah.
Keep your eye on the ball, keep running your business.
Mm-hmm. Yeah, got it. We've covered a lot of ground today, Greg. Is there anything that I haven't asked you that would be really helpful for my audience, our audience, to hear from you as a very experienced deal advisor that would be super helpful for them in kind of approaching the view of growing their business, adding value to that asset, or getting it ready for sale? Anything at all that might be helpful?
I think the first thing that they should do is talk to an advisor.
Yeah.
Most advisors will talk to you quite happily for free.
Right.
So you're not getting, it doesn't cost you anything, but a little bit of time.
Yes.
But talk to advisors.
Yes.
You talk to multiple advisors. You've got to have good chemistry with the advisor as well.
Yep.
Find somebody you like working with. I say we get a lot of referrals from accounting firms, and those are generally accounting firms that we get on well with, and we've got that same sort of chemistry, and they will understand that if they're bringing their client in, that they know that they're going to have a good sort of same sort of chemistry with us.
Yes.
So that's probably the key thing, is just go talk to people.
Yeah.
And in advance, don't leave it till the last minute.
Yes.
Just come and have a chat with us.
Yeah, makes sense.
Just get as much information as you can from people. Not a sales pitch for us, but on our website we've got this document I wrote, which is kind of how to sell your business, and it goes through working with lawyers and accountants and advisors and how you structure and what all this kind of the pitfalls and all this, and we will give that to people. Say, here, read this.
Yeah, great.
So I've tried to summarise the whole, soup to nuts, go to woe, sort of on selling your business. So it's not a dummy's guide for it, but it's it just kind of breaks it all down for people.
360capital.co.nz, the numerals 360.
Yeah.
Yep, great.
Yeah.
People will find you at Greg Young on LinkedIn as well if they wanted to hit you up and have a chat with you. So super straightforward, very easy man to find.
All our contact details on our website and all that stuff as well.
Yeah, cool. Okay. So parting question for you is the alternate universe career question. So you've landed in a space which is a very niche space. Being an M+A advisor is very, very niche. But in that other universe where there could have been another Greg who's 6'5", who is devilishly handsome with a silver beard, what would have been the career choice for him that left him deeply satisfied?
I love to cook, but I couldn't work as a chef. Just you see the
stress levels.
Yeah. But I love to cook. I just would love to do something with food.
Yes.
Not it's just food, mine and stuff. It's food. I love the putting stuff together and creating things and and eating it. And I make a lot of sauces and different sauces. I make up sauces, and that's other one little sort of pet passion is just different sauces.
Yes.
But I don't know how the hell I'd make any money out of that. So
yeah.
It's just a hobby.
I've got this hallucination of Greg when he exits 360 Capital of there being a farmer's market and me coming across Greg with 17 different types of sauces in there.
Don't laugh.
No, I'm not.
It could very well happen.
I'm looking forward to it.
Yeah.
Greg, we've covered so much ground today. You've been really generous with your knowledge and your insights. I mentioned our audience is entrepreneurs and people inside corporates. And so this has been it's just such a great broad, but also we've gone deep in quite a number of subjects. And it's stuff that people do not talk about and people that they just don't know about it. And so thank you so much for your time,
pleasure.
Your generosity of insight and wisdom today. And I really appreciate you coming on the show.
Thanks for having me.
Thanks, Greg.
Cheers.
If you enjoy these episodes, I hope you do. I love filming them, and the guests always say what a great and often cathartic experience it is for them. Then please do like and share. Hit me up on LinkedIn. I'm open to connect requests, and occasionally get emails from people as well asking me about my experience around certain subjects. So please do like and share and continue to follow the show. I really appreciate your ears.